Alright guys, welcome to episode number 9 of the FVT Trading Bootcamp, where I'm going to take you from A to Z, pretty much from the beginning to the end of the way I like to trade. And if you're a beginner, or even if you've been trading for a little bit, if you haven't achieved any success or passed accounts, this bootcamp is for you. Now today's episode, we're talking about time. We're talking about session times. We're going to talk a little bit about macros. We're going to talk about session times. We're going to introduce the concept of macros. We're going to talk about different volatilities that come at different times. We're also going to talk about news events, right, and how they impact the price action. Because here's the important thing, right? I'm going to start off with this. You should trade, and I trade when I'm available. Just because the highest volume session is the New York session doesn't mean I have to trade it. So if you're from Australia like myself, or from a country where New York session is a bit inaccessible, maybe you're working or maybe it's too late, too early, then don't feel like you have to sacrifice your sleep and your health for trading, because it's honestly not the way to go. When I first started trading, that's exactly what I did. And let me tell you, it's not worth it. Now, we're going to start off with this. We're going to talk about session times. Now, I want to just put it out there. The market opens at 6 p.m. and this is all in New York time. So if you have a look at the bottom right-hand corner of my screen, it says UTC -4. It's always set to New York time. In a couple of weeks, right, in a couple of weeks time, the times will change a little bit, and I'll talk about that in one of the future videos. But for the meantime, leave it at that and you'll be sweet. Now, the main things you got to keep in mind with session times and volatility is this. And we can have a look at this on the charts that I've previously marked out for you guys. You can probably see that visually, just visually, you can see that the market moves a lot more when? The market moves a lot more in New York AM session. If you just go back in price and you mark out all the massive moves, right, the ones that move quite a bit that you can see that are really obvious, not all, but most of these moves happen in New York AM session. Now, when is New York AM session? Well, New York AM session is between roughly about 9:30 in the morning till about 12 p.m. That's just where the most volume comes in, right? You can trade before that, you can trade after that, but that's just when the most volume comes in and when most people like to trade it, number one. Number two, New York PM session. Now, there's many different approaches towards this, but a lot of people do not trade from 12 p.m. to 1:30. My take on that, and this is again New York time, my take on that is if that's when you can trade, you trade it. If you can trade other times, then maybe you trade after 1:30 p.m. So New York PM session technically starts after 1:30. So from 1:30 p.m. onwards, that's when most people start to trade. But again, I've taken good trades in the past, trading at 12 p.m., 1 p.m., 1:30, 2 p.m., 3 p.m., and so on and so forth. And what you're going to notice, and this is something to reflect on, is in terms of time and in terms of volume, guys, after the market has a really big move up or a really big move down, one or two things are going to happen. One of those things is tradable. The other, one of those things is not. And what you can see in this example here where my cursor is, we have a massive move up. Look, 9:30, massive move up. And then pretty much the start of PM session, the market does nothing. And this type of price action, you do not want to trade. So after a big move, if you're trading the next session, one or two things can happen. We're either going to chop an accumulation, or after a big move, we reverse back in the opposite direction. Now, you don't know what it's going to do. You don't know what it's going to do. But my, interpretation of this is if you've had a big move in the previous session, just be cautious. Just be a little bit cautious. I'm not saying don't trade, just be a little bit cautious because the next session may be choppy, but it can still be tradable. So again, that's the New York AM session. That's the New York PM session. That's technically the lunch hour. You can still trade that too. If we're talking Asian session, a lot of people ask, what are the best times? What are the best macros? It just depends where the market structure lies. So what we talked about in, a couple lessons ago about sweeping liquidity, tapping into a 15-minute fair value gap, and then forming an inverse, whenever that happens, that is the time to trade. Because here's the thing, you need time and you also need price. You can't have one without the other. My belief is that price and time come hand in hand. It's not just macros, it's not just silver bullet, it's not just one session. It's those things in combination with price. And what is price? What we talked about, I think, in episode 7. That's a really good introduction to how you use price. So again, those are those sessions there. Asian session, if you trade that, because I trade that, I'll look anytime from 6 p.m. to 12 a.m. and I'll have areas on my chart where I want to see price react from. And if it goes to that area, if I get alerted to that area, then I'll trade. If not, then I'll let the markets do its thing. And then the other session I'll trade is the London session, but in particular, it's called the London Open session, which is from 2 a.m. to 5 a.m. And just know that most of these sessions have what's called a Silver Bullet time frame. And Silver Bullet is just something that ICT, I guess, has come up with, where you can look for trades to be in that time frame. So for example, Asian session, I'm not really sure if there is one specific Silver Bullet, so I'm just monitoring here and there for that session. London session, you're looking at 3 a.m. to 4 a.m. New York AM session, you're looking at 10 a.m. to 11 a.m. And for New York PM session, you're looking at 2 p.m. to 3 p.m. Now you might be saying, well, Ruben, what do you mean? There's all these times that are, you're putting on the screen here, putting on the chart, but I'm spending a bit of time, no pun intended, talking about this because a lot of people get confused with this. The blanket statement is that you can trade whenever you want, when you're free. You should trade when price and time align, not just because it's Silver Bullet. Just because this is a big misconception that I, fell victim to. Just because it is this time does not mean there is going to be a good setup. Just because it is this time does not mean it'll be a good setup. And the same goes for PM session. That's really, really important. And a lot of people go, what do you mean? That's the best time to trade. No, it's not. The best time to trade is when the market structure is good. And if you can line up time with that, even better. That's just the reality of it. Because have a look at here, for example, and I just want to illustrate this in the charts. Silver Bullet is between 10 to 11. When does this massive move happen? When does this big move happen? Have a look at the candlesticks. Look at 10 o'clock. 10 o'clock is this candlestick. What does price do from this candle to this candle here? Nothing. It barely moves. So you're telling me that just because that is Silver Bullet, just because that is 10 a.m. to 11 a.m., that's the best time to trade. No, it's not. The best time is when it lines up with market structure, and any time in that range is great, right? Any time in that range is great. So the same thing can be said for other days, right? Say for example here, look when we drop, that's 9:30, we drop. 10 o'clock to 11 o'clock is here. We have a little bit of a setup, but the main move starts from before. So keep that in mind. Just because it's Silver Bullet, just because it's a macro, which we'll talk about, it doesn't mean that it's a good time frame to trade. You have to have the market structure there. All the market structure elements that we talked about have to be there before you look at even engaging price action like that. That's very important. So let's go back to the 1 minute chart, and I've obviously annotated some things already, but I want to use those to discuss time and price. So let's go back to this first example here. Now, in terms of Silver Bullet timeframes, just to illustrate this here for you guys, if you really want to trade Silver Bullet, right, so you've got 10 o'clock here, and then you've got 11 o'clock here, what would be the framework to use here? And let's try to implement some of the concepts that we've learned already. I'm trying to build upon all the concepts, right? Let's try to build upon the concepts. Can you see where price has swept liquidity in this time frame? Can you see? And I'm going to mark it out. Price has swept liquidity here. Can you see where price has engaged a fair value gap? Yes, right here. So what else do we need to take the trade? We just need an inversion fair value gap, which is here. Bang. And that becomes an entry if you wanted to go long to move higher. In the past, all we've done is we looked at higher time frame examples, but you're going to see that this applies to the lower time frame too, right? And that there is obviously the New York session, AM session, Silver Bullet. If you go to PM session, you might say, well, what about PM session? I told you guys already about when the price has a massive move up, often the PM session is going to be choppy, and that's what you can see here. So 2 o'clock to 3 o'clock, there is nothing here that's worth it. And you might say, what do you mean? Look how choppy that is. Compare that price structure to this price structure. Not tradable, don't worry about it. Tradable, if you're interested, you can look at that. Now, the next thing is to discuss the London session and the London Silver Bullet, which is from 3 o'clock to 4 o'clock, right? So we're going to go here, which is 3 o'clock to 4 o'clock, which is here. Now, mind you, with my Discord and for my own personal trading, I trade in London session all the way from 2 a.m. or even earlier, roughly about here, all the way till there, or until the setup forms. Does that make sense? So it's really important to keep in mind. Now, obviously, if you look at that, we can try to apply the concepts that we've learned already. You can see price has swept liquidity. It's also swept liquidity here on the internal. And if you're curious about what external and internal liquidity is, I'll make another video on it. But essentially, external liquidity is higher time frame liquidity. And so if we go back here onto the 15-minute chart, just so you guys can see, 15-minute chart here, you can see that this is a 15-minute high. And we talked about that in the liquidity lesson. We talked about 15 minutes highs are really important. And this is also time-based liquidity, being Asian session liquidity. So we sweep liquidity. And what was the next step? We need to have a fair value gap. We do have a fair value gap here. So notice how I'm putting the pieces together. We sweep liquidity, we tap into a fair value gap. But I mentioned in episode 7, if you haven't watched that, watch episode 7. I mentioned in that episode that you look for the sweep and you look for the fair value gap on the higher time frame, but then you look for the inverse on the 1-minute chart. And you can see these volume imbalances and these fair value gaps get inverted here. So that becomes an entry to go short, right? And what does price do? Price moves lower. So it's really, really important to consider this, right? New York session has the most volatility, followed by, like New York AM session, probably followed by London and PM, and then the least volatile session or the least movement of a session, it's probably going to be the Asian session. However, a lot of people say you can't trade it. Yes, you can. Yes, you can. You just need to be flexible, and you have to kind of shy away from the closed mind that a lot of people enforce into trading the Asian session, because it's not true. You can get 30 handles, 10 handles, 20 handles, 50 handles in Asian session, but it's about the market structure. Because look at this move here, look, right? This is in the Asian session. And this here, this green box, if I go back, let's apply the same rules. Again, you haven't seen this in the 1-minute chart, but go back here, right? And let's apply this concept on the 1-minute chart now. 15-minute, you can see, we come down, what do? We sweep out this level of sell side. We talked about this in episode 7. We tap into a 15-minute fair value gap. Great, that should be support. We go back onto the 1-minute chart, right? And then what are we looking for? We're looking for an inversion fair value gap on the 1-minute chart. This could be the inversion. Do we get that? Let's have a look. Bang, that's your entry. And where do you take price to? Again, you take price to nearby liquidity or imbalances. So that's the thing. This is a great move in Asian session. So to say that Asian session doesn't move enough to trade, it's a little bit wrong in my opinion. And that's the only thing I'll disagree with anyone, that Asian session cannot be traded. It can be. And I know a lot of people say you got to grind, and if you really want it, you got to, sacrifice sleep, maybe for a little bit, but in the long term, guys, I've done it and it's not worth it. So Asian session still has enough volatility, but what I noticed with Asian session is that once a move has already happened, like a decent move, if you've missed that, hop off the charts, because usually there's only one or so moves in Asian, whereas in other sessions like New York or London, whatever it might be, there's often more than one, right? More than one move. But you'll see sometimes like London session is choppy, other times it's not. And we can apply that to any session. We did Asian session here, London session here, New York session there. We can even go back here. Look, this day, let's look back here. This day, the PM session Silver Bullet actually provided a setup. And so I want this to be very, very clear. And I know it's a longer video, but this is an important topic, starting to merge some of the concepts. Just because ICT or anyone says that a certain time often produces setups, does not mean that there will be a setup. And I want you to just keep that in mind. Just because ICT or myself, anyone says that this time frame most of the time has setups, doesn't mean it's a 100% thing. So approach the markets to trade what you see rather than trying to impose what you want to see. Really, really important. Okay, cool. Let's apply the same concepts here. Let's go and select a new bar, start a new one, and let's go right here. And then we'll talk about macros, I think, briefly here, and then I want to do another video probably just solely on macros, because that's a really important concept. So this is more like session times, silver bullets, and all the rest of it, just to show you how it all comes together. Now, let's go back on the 15-minute chart. Let's try to apply the same rules that we talked about before. Let's remove all this, get rid of all this. Let's zoom out. Okay, so have a look here, guys. We sweep liquidity. We tap into this 15-minute fair value gap. What do we then do? We drop back down to the 1-minute chart. And again, this is like a bias building exercise. We also sweep internal liquidity here. Again, external, higher time frame, internal, lower time frame. And then what you're looking for is you're looking for an inversion fair value gap. Some people wait for this, which is nothing wrong with that. What does price do? We invert that, And ultimately, what does the price start to do? The price starts to move higher. And that's it. So obviously there's more to this, but you can start to see that these concepts align. And there's enough volume in every session. So this is the PM session here. If we just get out of this chart replay, just so I can show you guys, you can see that there was a setup here in the New York session, right? There was a setup here short in the London session. There was a setup here long in the Asian session, setup here long in the PM session. And you're gonna see this apply time and time and time again. Some markets are gonna favor people that want trends. Other markets are gonna favor people that want reversals, right? And sometimes they don't favor anything that you want, right? So sometimes they don't favor anything that you want. In this case, look at this. In the London session, which I mainly trade, this is 2 o'clock. There's a nice long position here. And then what does the market do? It offers shorts. So if you want a long, you can take a long. If you want shorts, you can take shorts. Go back to the Asian session, right? If you want longs, there's longs from down here, from down here. If you want shorts, well, there's shorts from up here. So notice how the market is going to offer you many, many opportunities. And the same goes for New York session, right? If you wanted longs, you could have taken a long from here. Boom. If you wanted shorts, you wait for the sweep and then you look for the reversal. And that's the important lesson. Yes, there's different volatilities. Yes, time is important. Yes, New York session often moves more, but it does not mean that that session is better than Asian or London or PM. The best session to trade is the session that you guys can trade. It's the session that you guys can trade. And that's just a really important concept to keep in mind. So that's that part. Now, the second part I want to discuss is there's volatility injection. We'll talk more about this as time goes on, but there's volatility injection when there's news events like CPI and PPI, right? So in terms of volatility, if you look back here, right, when CPI happened, you can see what it does. So you don't trade until after CPI. You don't trade right here. You don't try and catch a windfall. Like I know some people try to pass accounts and stuff. Don't worry about that. If you're starting out trading, trade properly, wait until at least 9:30. And then from there, obviously, you can decide if you want to trade or not. That's what I'd say. Right? There's no point in trying to trade before a news event. There's no point, right? So be smart about it. The big news events are CPI, PPI, NFP. Those three are for the New York AM session. And then you've got FOMC that's in the PM session. There is nothing really that impacts the London session, but what I would say with the Asian session, you do get new day opening gaps and you get new week opening gaps. And an example is today, right? Look how the price closed yesterday or on Friday, and then how it opened today. That gap is called a new week opening gap because it's at the start of the week. And sometimes you get those every day and they're called new day opening gaps. So if it's at the start of the week on the Sunday, Monday, depending where you're from, it's a new week opening gap. If it's in, Tuesday, Wednesday, Thursday, then it's a new day opening gap. And I'll show you guys some examples. So have a look here, for example, right? This is a gap that opened on the 23rd. That's a new day opening gap. And often the new day opening gaps are going to be a bit smaller than the new week opening gaps. And all you got to do is go to your charts and have a look at the open, 6 o'clock. Usually there's a gap, right? That's a new day opening gap. And as you go back in time, right, you'll see exactly the same thing. If you scroll back to any day, most days have these gaps, not all of them, but most days have these gaps. When there's no gaps, like here there is a gap. When there's no gaps, I would advise myself to not really trade or look at trading the Asian session for a little bit. Let more price structure form, because often what happens if there's no gap, if there's no volatility in the first hour or two of the Asian session, or the first 30 minutes even, chances are it's going to be very annoying and very choppy. Like look at this, we gap, but look at the first 40, 50 minutes. It does nothing. That is a signal to you if you trade Asian session to wait a couple of hours. And if you're patient and you wait, again, you wait for liquidity to be swept. Then you look for your entry model, your inversion. You look for that hopefully to occur in a good time frame. We'll talk about macros in the future. And then you take your trade and you target, again, we talked about liquidity. We target low resistance liquidity here. So this video, I guess, is meant to be a bit of an overarching video, talking about different session times. The main points you want to take away from this, there's New York session AM, there's New York PM session, there's London Open, there's Asian session, but you can trade in between that based on when you're free. It's about lining up market structure with the time that you can trade. So here, for example, that's a good trade. Here, for example, that's a good trade. Why? Because it's done an important thing in that time frame. Down here, look, we've swept PM session lows and then we react. Here, we've pulled back into the range. We'll talk more about that. So it's just important to consider that. The best times to trade are the ones that line up with market structure. And that's just how it is, because candles have to print, market structure has to be developed. And I know we've covered a lot today, but my advice would be to cover those main points. The different sessions, the lunch hour, a lot of people avoid it. Understand that if one session moves very large, the next session may be choppy. News events, we'll talk more about it as time goes on, but that's when a lot of volatility gets injected. So wait until after the events. If you trade the PM session, you can trade after FOMC, but on FOMC day, do not trade the AM session to be very choppy. And yeah, sometimes those events can impact price action in previous sessions too. So if you look back, even to CPI, yes, sometimes the sessions prior can be choppy, but not always, right? You can see here, they're still tradable, right, to a degree, but then it goes in the chop, especially as you get closer. The closer you get to these events, the more choppy the price action will be. So just a few key points there, guys, talking about volatilities, talking about session times, merging a few of these concepts together on the 1 minute chart. And yeah, this will conclude, I think it's episode 8 or episode 9 of the FVT Trading Mentorship, or Bootcamp, I should call it. And if you haven't yet joined the free Discord, go and join that, because in there I've got a complete, I guess you could call it, forum where we can work together. And if you have questions, feel free to ask them there. But yeah, until next time, guys, all the best. We'll talk very soon. Peace out.